Continuing with topic 4, paper 12, we're now going to continue looking at risk-adjusted performance measures, and it's the turn of Jensen's alpha, middle of page 4.23. Now, the Jensen's alpha is the average return of a portfolio over and above that predicted by the capital asset pricing model. So the capital asset pricing model suggests or predicts the return that you should get for the systematic risk of the portfolio and the other items in the capital asset pricing model, the market return and the beta of the portfolio. Now, a portfolio with a positive Jensen's alpha will have outperformed the market. That's the important point. So we drop the Jensen's. People talk about alpha, searching for alpha. And what we're talking about is our portfolios that have outperformed the market portfolio. Now, a portfolio with a negative Jensen's alpha will have underperformed the market. So what we're doing is we're taking the formula to be RP, the return of the portfolio we're looking at, minus the return predicted by the capital asset pricing model. In the capital asset pricing model, you've seen earlier, risk-free rate plus the beta of the portfolio multiplied by the market premium, that is the return of the market, minus the risk-free rate. Let's look at an example. Top of page 4.24. And we're asked to calculate Jensen's alpha for each portfolio and identify any portfolio that outperformed the market portfolio. Well, that will be portfolios with a positive alpha. We've seen this data before in the previous section. So let's do the calculation. Now, the market portfolio alpha must be 0 because what we're doing is we're taking the market portfolio return of 0.1977 and we deduct the calculation of the market portfolio return, that is the risk-free rate 0.07 plus the beta of the market 1 multiplied by difference of the market return and the risk-free rate. Right, we do the same calculations, but for each return portfolio A, B, and C. So the return of the portfolio is 0.14, 0.16, 0.18, just moving down. For each of those, we deduct the return expected from the capital asset pricing model. The risk-free rate is the same in each case, 0.07, plus the beta of each portfolio, which is given to us, 1.1, 0.9, 0.8, and then we multiply each of those by the market premium, 0.1977, the return of the market, minus the risk-free rate. Do the calculation, and we find that fund manager A has an alpha of minus 0.0705, so has not outperformed the market. Similarly, fund manager B has got a negative alpha. Fund manager C, however, has a positive alpha, 0.0078. So that is the portfolio that's outperformed the market portfolio. And interpreting Jensen's alphas, portfolio A has underperformed market portfolio, lying below the security market line. Portfolio B has also underperformed the market portfolio because of the negative alpha and lies below the security market line. But portfolio C has outperformed the market portfolio and lies above the security market line. Now, please remember that the capital market line is relevant to the Sharpe ratio, whereas the security market line is relevant to both Trainer Index and Jensen's alpha, because they're looking at beta, which is measured by the security market line. Okay, let's continue. Tracking error. Tracking error is the volatility of alpha. So are we achieving alpha and are we doing it consistently, or are we all over the place? Performance of asset allocation managers can be measured by the consistency of outperformance in each period. Tracking error measures such consistency by computing the volatility or dispersion of alphas. So we're taking all the alphas and calculating the standard deviation. Tracking error popular performance indicator among asset managers. Moving on to the information ratio, it reflects asset managers' ability in making profitable bets. The higher, the better. And so we are comparing the average monthly alpha to the monthly tracking record, and we want that as high as possible. An example that we've given here for a particular portfolio: average monthly alpha 0.052, monthly tracking error 0.163. What's the annualized information ratio? And to annualize it, we take 12, the square root of 12, multiplied by 0.052 over 0.163, giving 1.105. Yes, they can examine both tracking error, concept, and information ratio, concept and outside chance calculation. Moving along to attribution analysis. So we're wanting to know where the performance is coming from, certainly outperformance. What is it attributed to? So the points here: to monitor portfolio performance, attribution analysis identifies performance attributable to each set of active decisions. Performance broken down to three components: tactical asset allocation, sector or industry selection decisions, and security selection. And you'll see the last two we tend to take together. Now, this diagram is a good reflection of the concept of performance attribution. Now, we've got a benchmark A, what we are looking to achieve, and you've got the benchmark return on the y-axis and the benchmark weight on the x-axis. Now, we're going to do an example and you'll see how this works. In actual fact, the return is higher than the benchmark return, and the actual weights were different from the benchmark weight. Now, this diagram's assuming the actual weights are higher, but sometimes they'll be lower, and that will give a negative number, and we're going to see that in a moment. Now, the actual total return is the benchmark return A plus B plus C plus D. So the outperformance is represented by B plus C plus D. Now, the contribution from sector and security selection is the area B, and the contribution from tactical asset allocation is D. So those are very distinct. What about area C? It's attributable to both components. However, we usually include them under the sector and security selection. So you look at B plus C compared to D. While attribution analysis helps measure the effect of an asset manager's decisions, the strategic asset allocation generally greatest influence on portfolio's risk and return characteristics. So be aware of that. That may be examined. Attribution analysis is seeing how the active management has borne fruit or not. But the strategic asset allocation usually has a greater influence on the overall portfolio's risk and return. Whether you're in equities, bonds, you keep the money in cash. Okay, let's look at an attribution analysis example. From the information, we're asked to calculate portfolio excess return, and then tactical asset allocation contribution, and the sector and security selection contribution. Now, from the diagram previously, you should see that 2 plus 3 will give you B plus C plus D, which is the portfolio excess return. So if I was to give a short formula there, 1 equals 2 plus 3, which often is the relationship you should be aware of to answer a question on attribution analysis. Okay, so we've got stocks, bonds, cash. The benchmark weight 0.6, 0.3, 0.1, and the return 5.81, 1.45, 0.48. So that's what we're aiming for, the benchmark. Then we've got some active management, and the actual weights turned out to be 0.7. In 70% of the portfolio went into stocks, 7% went into bonds, and 23%, 0.23, went to cash. And the actual returns achieved 7.28 as opposed to the benchmark 5.81. So we did better stock selection. 1.89 for bonds as opposed to 1.45, and 0.48 for cash, same as we had predicted in the benchmark. So what's the overall portfolio excess return? And the way that we do this is calculate the benchmark return and then calculate the portfolio return. So it's a weighted average. So you can see we take 0.6 multiplied by 5.81 plus 0.3 multiplied by 1.45. I'm just going down the benchmark weight return combinations, and the cash 0.1 multiplied by 0.48. Perform the calculation, we get a benchmark return average of 3.97. If we do the same for the actual portfolio return, we get 5.34%. So the actual return, 5.34, significantly greater than our benchmark of 3.97. So we've outperformed by 1.37. The portfolio excess return is the portfolio return minus the benchmark return, giving 1.37. So what's the tactical asset allocation contribution? Well, here we're looking at the difference in the benchmarks. So 0.7 minus 0.6. That's the asset allocation, the difference between what we actually went for and what we predicted, multiplied by the benchmark return, 5.81. And we do that for each stock, bond, and cash, and we get the contribution from tactical asset allocation of 0.31. Now, when we look at the sector and security selection contribution, we're looking at the differences in the returns achieved compared to the actual weights. And you can see the calculation under 3, and that comes out to be 1.06. But we could have got the sector and security selection contribution in a much faster way, because we know that the portfolio excess return is the tactical asset allocation contribution plus the sector and security selection contribution. So if we know that the portfolio excess return was 1.37, we then deduct 0.31 from it to get the sector and security selection contribution of 1.06. So in the exam, if they give you the portfolio excess return and one of 2 or 3 and ask you for the other, then it's a very quick, easy calculation. But if you don't fully appreciate that relationship, you may be tempted to go into the detailed calculations, which will take you that much longer. Please be aware of the calculations for attribution analysis. It can be examined. Moving into section 7, reviewing and monitoring investment management process. Well, we started topic 4 with this, the investment management cycle, and we're just reminding ourselves what it looks like. That is defining investment objectives and constraints. Then we set the investment strategy. Then we implement and manage the portfolio. And we continually monitor and review the performance, which leads us back to adjusting investment objectives, constraints. Well, we can't adjust constraints, but certainly the return objectives and the strategy and the management may be altered. So what is the feedback mechanism? When reviewing investment objective, 2 critical questions should be asked. Based on the analysis of the fund's performance, should investment objectives be changed? That's just what I said. Have the client's objectives changed? Significant changes to investment objectives may require adjustment to the strategic asset allocation, and reviewing the way a portfolio is implemented and managed may involve placing a manager on watch. You may have a number of investment managers you're using. You put one on watch to see how they're performing on a regular basis. You may want to switch investment manager. You retain a manager, but clarify specifications and expectations because you're not happy. Review tactical asset allocation process, or take no action at all because you're happy. Finally, Section 8, and I have seen questions on this, the role of the fund research house or the rating agency. So fund research houses and the rating agencies, they produce reports on funds and investment managers to help investors select or monitor fund managers. Now, most advising firms do not rely entirely on recommendations made through this research. They'll also consider their own research. And it's in the best interest for fund managers to work closely with fund research houses, the rating agencies, to ensure that their performance is being portrayed accurately. Any information that they think the research house could benefit from, they will provide. And successful reviews will help maximize fund managers' branding opportunities, because it is a business after all. Well, that brings us to the end of topic 4 of paper 12. Indeed, it brings us to the end of the material for paper 12 on asset management. Now, there's a lot of technical material in this, and one of the best ways to prepare and make sure that it is in the front of your memory, dealing with short-term memory, is to do the practice questions. And as I've said earlier, Examinator.online has many paper 12 practice questions with audio explaining the answers all embedded in it. So I would strongly recommend that you go to Examinator.online for your question practice. Leaves me to wish you all the best of luck with your paper 12 studies and eventual passing